And I will pass things over to Jack.
Perfect. Thank you very much, Ryan. Just let me share my screen here. Okay. All right here. Okay, so I'm going to get things started here on the US side of things. My name is Jack Bruton here, and here we go. So if you, after this presentation, please feel free to send us an email to cacpmssupport@morningstar.com. We're always happy to incorporate new and innovative ideas that can add value. So we're going to follow a similar structure to what we've done in the past here. So first of all, we'll start off with market performance, then we'll take a little look at best sectors and stocks, follow that up with a little bit of a quant dive and do our single factor analysis, or SVT test as we like to call it here, and finish off with just a market fundamentals and general outlook. So 2020, it really has been the tale of two quarters. Following a dismal Q1, Q2 had a great bounce. It was up 20%, the S&P 500. Keep in mind that is only price return, so it's not including the reinvestment of dividends. Most of that gain was in the first 2 months, so April and May, and that is mainly due to the large fiscal and monetary stimulus that the Fed pumped into the system. I believe now it's around $9.5 trillion. So the market really liked that. Some notable days in this quarter. April 6th, so right around here, you can see that the S&P 500, it rose 7.3%, and that was fueled by some data that came in saying that corona cases in the States were on the decline. Obviously, that's not the case right now. And over here in June, on the flip side, the worst day was June 11th, when it decreased 5.9%. And that was because Jerome Powell came out and said that there was significant uncertainty surrounding the economy. Overall, the S&P 500 had 17 sessions of being up 2% or more over the quarter. Here we're looking at Q2 total return. So you can see the tech-heavy NASDAQ had the best overall results, being up 30.95%. And actually, after Q2, it went on to go make all-time highs. I believe as of this morning that it's up 17.6% year to date, so it's quite impressive. The S&P 500 was up 20.54%, with the small cap Russell being up 25.42%. Here we're going to be looking at market breadth. So this is the percent of stocks with a positive total return. Just to give you a little bit of a background on how I calculate this, I don't care if it's up 100% or I don't care, or if it's up 0.001%. All I care is the fact that it is indeed positive. So you can see the S&P 500 had breadth of 92%. So that means 92% of the 500 names within the S&P 500 were positive, which is fantastic breadth. S&P 400 is up 88% breadth, and the 600 had 82%. This is a historical looking graph as on the market breadth of the S&P 500. And you can actually go back and see since 1993, the S&P 500 has only had over 90% market breadth only 4 times. So it's really quite historic. Here we're going to be looking at the Q2 total returns. You can see energy was up 30.51%. That's something that we don't see very often. Actually, I believe it was in April, oil traded negative for the first time, and then it rallied. So some energy names did quite well on there, and it had perfect 100% breadth. Materials was up 26.01%, with gold making an 8-year high. Information technology continuing to do its thing, up 30.53%. And then you can see over on the right-hand side, the best performer was Apache Corp, was up 223%, which is kind of ironic because last quarter it was the biggest, was down the most, it was down 82%. So it really rallied over Q2. And the worst overall performer is Xerox Holdings. This is just a visual representation of the previous slides of how these sectors performed. So Market Access is it's a financial services company that services the credit market, provides a trading platform, and it actually did quite well over the quarter. And this is just a representation. It's plotted against the S&P 500. And I really wanted to take a look and see how it placed in our strategy. So you could see it, we're actually holding it with these little hands here, you could see under currently held in our earnings growth, earnings momentum, momentum breakout, and momentum breakout 10. We bought them all in April, and it's actually done quite well for us, right? So we're picking, so we're just goes to show you that the strategies are working and picking good names. Here, this is something new that we added last quarter. I was really interested in seeing how different metrics changed given the current environment, what we're seeing. So this first column here is the first known corona case, November 18th. So you could see that's really, like, I guess, the norm, I guess we could say. You see that the PE of CYM, so the price to earnings of the current year median was trading around 18 times. Estimate revisions were around negative 1.8%. Then the market bottom came on March 23rd, and analysts revised downwards only a little bit by down to 5.9%. You see the PECYM dropping significantly. And now, then April 17th was the last time we ran this report of last quarter. You could see that they revised down significantly. So I always thought it was interesting just the amount of time it took for analysts to sort of just come in and make process all the information and make their judgments. So now it's at negative 20.2%. Current year median EPS growth at that time was expected to be negative 13.6, but a strong rebound next year of 22.4. Now, as of June 30th, you can see they revised downwards a little bit more, and now the market based on a PE current year median is actually at 24.7 times. So it's significantly more expensive than it was back in November 18th during the first known corona case. We're expecting a current year median EPS growth to be a negative 20.6, but an even stronger rebound coming in at 29.3 next year. Here is the top 15 US stocks trading at a discount. So this is from our team out in Chicago. Just to be a little bit of repetition here, just based on what we said on the Canadian side of things. So this MS fair value is what our analysts think that the stock should be trading at, right? And at Morningstar, we are long-term value-oriented investors, and we invest in good businesses with distinct competitive advantages that have a moat, and we assign a moat based on these 5 factors here, which I'll touch on shortly. So this MS fair is what we think should be trading at. The PR now is the price now. RMS fair is the potential upside. So Technip FMC PLC has a potential upside of 438%. Now touching on this MS moat variable, we either assign these companies a no moat, which would be a 0, a narrow moat, which is a 3, or a wide moat, which is a 5, and that is the best. And we're assigning these, we're looking at 5 factors here. So we're looking at intangible assets. So do these companies have any IP, brands, patents, or are they protected by the government? We also look at a cost advantage standpoint. Are they able to produce their goods at a lower cost than competitors, giving them an advantage? A switching cost, right? Is it a major pain to switch from one company to another to substitute their products? From a network effect. So network effect, again, a perfect example is Facebook. So it's when the value of a particular good or service actually increases as new and additional users sign on, right? So a perfect example, again, would be Facebook. So let's just say I have a group of friends that are currently registered as Facebook users, and I am not. So in order to get in contact with them, I have to register to use Facebook. That's good for Facebook. It's new users, new potential ad revenue. Now, let's just say that now once I'm on Facebook, I have a bunch of friends that are not registered. So in order to get in contact with me, they'll sign up to Facebook. And it really just creates that vicious cycle that goes around and around, and it's extremely powerful in my opinion. Now, finally, efficient scale. That is classic economics. So it's when an industry or sub-industry is effectively governed by a few players, and other players that are not in that industry will actually stay out, because if they were to enter, it would be unprofitable for everybody. So they stay out. And keep in mind, if you do want more information on our methodology, please click this link down here. It'll direct you to our methodology report. And all of these variables you do have access to them. So please take a look. I think that they're relatively sort of underutilized. Now we're going to be taking a look at the Q2 best and worst performers within the S&P 500. So here you could see Apache up there at 223%. Materials is up. You see Freeport McMoRan Copper. I would have expected some more gold companies to be in there, just given the rise of gold. We see in consumer discretionary a lot of names in there. You see Gap, eBay, Chipotle. And then going down to information technology, you see PayPal being up 82%, just capitalizing on this sort of cashless society trend that we're seeing. On the worst overall performing, we're seeing a lot of utilities, right? Just over here. And I really think it was due in part, given the fact that I think it was very much a risk-on appetite for investors in Q2. Utilities tend to be a little bit more stable, a little bit more safe. So maybe that is a potential reason for that. Here, what we're going to be doing is we are comparing the top 50 and the bottom 50 names that we just saw on the previous slide. And we're going to be looking at what they exhibited in terms of attributes at the beginning of the quarter. Just want to see what was rewarded and what was really punished, right? So this first column right here is the S&P 500. That's what it's weighting at. And the second column is the actual top 50 equally weighted. This is the number of standard distributions away. And over here, this fourth column is the portfolio at the top of the bottom 50 equally weighted. And then this is the number of standard distributions away. So you can see the best 50 stocks were significantly undervalued on a PE basis, price to trailing cash flow, price to book, price to trailing sales. They had poor earnings momentum and higher median EPS growth next year. And the worst, you could see that they were undervalued, but not as undervalued as the top 50. They also tended to be lower beta stocks and have higher earnings momentum. Now we're going to take a little bit of a quant dive. We're going to take a look at see what factors were rewarded or punished. So we could see that price to cash flow and price to book did quite well. So if you just bought the top 50 names, based on a price to cash flow, you would have returned 39.3%. So that sort of tells me that value was it's based on a single factor, value was very much in, but as we'll see, that really wasn't the case in another slide. And if we go back to those previous slides up here, you could see that price to cash flow and price to book was a very big attribute of those top 50 names. And anything above this red line performed better than the S&P 500. Now we're going to take a look at our pre-built or predefined portfolio. Something that's pretty interesting that I've only seen once here was that Dangerous was our top performing strategy. So Dangerous is our contrarian strategy. So it's looking at companies that really aren't very attractive from a fundamental perspective. Lots of debt, decreasing cash flows, estimate revisions downwards, right? But it actually was our top performer. So it goes against logic or convention, right? It just goes to show you the type of market that we were in, especially in April. That was up 30.70%, which is substantial. So anything was working in April, and anything above this line here beat the index here. Now we'll finish off with just a market fundamentals and general outlook. Here we can see that the median ROE actually decreased from the previous quarter, and the estimate here is expected to decrease substantially. Now we don't see the estimate decreasing very often. I think last quarter was the first time that I ever saw that happen, and it's expected to decrease more so. And we saw the price to book obviously increasing with the massive market rally that we saw. Here, we're expecting the estimate for the median earnings growth for all companies in the S&P 500 to be cut significantly down to I think 60. We have the estimates have been slashed significantly, and if we go back, you can see that they're even worse than the 07-08 financial crisis. Here this is just a general economic outlook. Unemployment's actually increased up to 13.3%, and that was from 4.4% in the previous quarter. I guess we'll have to wait and see what happens in the states in terms of their unemployment, as a lot of states are locking back down again. So we'll see. Here, we could see that the estimate revisions across the board are being cut significantly, with consumer discretionary being slashed the most at negative 58.6. Energy continues to be a very cheap sector. Financials is at 1 times, and now that was down negative. The estimate revisions are down negative 31.2%. Here's just the beats and misses of the S&P 500. So you could see here that consumer staples beat 79%, materials at 71, industrial 70, and overall the S&P 500 beat 63%.